Most life insurance policies never pay a death benefit. For one kind of buyer, that is still the right deal. For another, it is 10 times the price for the same coverage. Here is how to tell which one you are. You have heard two stories about life insurance. One says it is a scam you pay into and never use. The other says the right policy quietly builds you wealth. Both are selling you a feeling, not a number. It is neither a scam nor a savings account. It is a bet against one specific loss. Here is how the math works. Every insurance policy is a losing bet on purpose. You pay a little every year. The company keeps enough for claims, costs, and profit. On average, you get back less than you put in. That is true of every warranty and every policy. So the question is never whether the bet loses on average. It does. The question is what you are insuring against. A warranty covers a repair bill you could pay yourself. Lose that bet, and you are out a few $100s. Life insurance covers something you cannot pay yourself. Your entire future income gone in a single day. That is the difference that flips the math. A small sure loss to erase a small chance of ruin. When the loss is survivable, you skip the bet. When the loss is catastrophic, you take it. Take the person life insurance was built for. One income, a mortgage, kids who eat every day. A healthy parent around 40 can buy $500,000 of term coverage for about $50 a month. If they live, the money is gone. Good. If they die, the family keeps the house. That is a losing bet worth making every time. Now the version sold as the smart upgrade. Whole life, marketed as protection that also builds wealth. The same $500,000 in coverage. It costs 9 to 10 times as much. Around $500 a month, not $50. Over 30 years, that gap is about $162,000 for the exact same death benefit. The extra money buys a savings account attached to the policy. In year one, much of your payment is the agent's commission, so the savings part starts near zero, and most people never hold it long enough to win. Nearly 6 in 10 of these policies lapse within 10 years. You pay for years, cancel, and get back less than you paid. The same benefit, 10 times the price, that most buyers never collect either. Now, the case closest to a lot of people. A single adult, no kids, no one relying on their paycheck. They buy a policy because it feels responsible. But there is no future income to replace. The loss would fall on no one. A losing bet with nothing catastrophic behind it, which is the extended warranty all over again. So why do people keep buying the expensive version? The policy that costs the most pays the seller the most. A whole life sale can pay the agent most of your entire first year of premiums. Term pays them almost nothing. The product with the worst deal for you is the one they are paid hardest to sell, and it is sold with fear and love, so most people never compare the price. So here is what the math actually tells you. First, ask one question before anything else. Does anyone depend on my income to live? If yes, you have a catastrophic loss worth insuring, and term is the cheapest way to cover it. If no, most of the reason to buy disappears. Second, know that the expensive version is two products, insurance on one side, a savings account on the other. Ask the price of each separately. The bundle is where the cost hides. Life insurance is a losing bet on average by design. For the parent with people depending on them, it is a loss worth taking, cheaply, in term. For the person with no one to protect, it is the warranty all over again. The math never says never buy insurance. It says know which loss you are handing off and whether your family could survive it without you.